I think I would start to get excited if it was at that 100 level. When you're managing money for retirees, you can't take a blind eye to these massive companies anymore. A company that's worth $1 trillion or $2 trillion, realistic or not, is a different conversation. But when you have that much value in the private markets, it creates waves in the public ones. I've been doing this with clients for a little over a decade now. I don't think I've ever gotten as much questions about secondary markets at all. The companies like Nvidia, companies like Google, they're going to be the $10 trillion names.
Welcome to The Big Skinny with Lou Basenese, where we serve up the insights one headline you should probably ignore because the consensus often gets it wrong. One chart you should absolutely pay attention to because the data seldom lies, and one investment insight you can use right away to increase your bottom line right alongside ours. And it is my pleasure once again to welcome back Ted Thatcher to The Big Skinny, my friend. Good to have you back in New York.
Lou, it's always good to be with you, man.
Let's get right into it. The heart of this earnings season is kicking off. We have oil spiking back into the 80s. What do you make? You say it's a complicated relationship between the markets, oil prices, consumer. How do you sort out this macro backdrop for the back half of the year?
Yeah, it's really interesting because I think the markets in so many ways, we've been playing this like high stakes game of she loves me not, she loves me not with Iran. And it's okay, now we're back to the it's complicated relationship status. But the truth is in terms of the markets, as long as this war stays kinetic, the markets have to pay attention. And we've seen that reflected in Brent. You know, I think the futures opened on Sunday, spiked above 90. It's kind of stuck in the high 80s, hit back over 90. And so obviously so much of the narrative during this conflict has been about inflation. We saw a great CPI print, negative 0.4%, 10 basis points below the biggest decrease since basically the post-COVID decreases. That's not going to be very good news for Kevin Warsh. Obviously, so many of us have prayers and hopes of rate decreases this year. But we're just not going to see that if we see oil prices stay elevated.
Do you think the headline's like freaking out? Is there an oil price that you think gets us to, there's going to be persistent inflation? Because you said it. I mean, we saw the first spike, things came down. The next CPI, the next inflation print showed that it was indeed transitory. God forbid I say that word. Jerome Powell, rest in peace on that one. But do you think it becomes problematic if we stay over a certain level for another couple months?
Look, I think if we're in the 90s, I don't like it. Although in terms of what I actually believe is going to happen, this war is incredibly unpopular in the United States and with Americans broadly. So I think at the next opportunity for an off-ramp that we get, obviously we've been sending, I think we're on the 10th straight day of strikes in Iran. But I think at the next possible off-ramp, once we see some light at the end of the tunnel, we'll sort of see, if I could use the word V-shaped recovery in the price of oil. I'll expect it to drop. And so hopefully we won't see that persistent inflation and we'll continue with the trend that we have been on, which is, sort of the worst is behind us.
Yeah. Speaking of trends, I mean, I know people hear about it, but I don't think they understand how significant it is, the earnings trend, right? We're going into this year, $350 a share earnings estimate for the S&P 500. I think it's now notched at about 400. I mean, we're seeing acceleration of earnings growth. What is that? Why does that matter so much to you as you're looking at potential investments?
When you think about investments and like the Charlie Munger, Warren Buffett people of the world will love hearing this. It has to come back to cash flow, right? It has to come back to profits and real earnings. And so you're absolutely right. We had estimates, analysts were looking coming out of this year at $350 a share across the S&P 500. It has been revised to 400. And one of the reasons I'm actually fundamentally constructive about the second half of the year is exactly that. We came into the year, forward earnings multiple was about 19.4.
Yeah.
It's cheaper today, 18.4. It's really nice.
Do you know of anyone that predicted that the stocks were going to keep ripping the records and the valuations were going to come down? I mean, maybe you were prescient. I wasn't. So.
No, I think that there was a belief coming into 26 that we would see earnings growth drive markets in this year, but not the way that it has. It's been earnings growth. It's been, of course, the chip names, the memory stocks, semiconductors. And so, again, fundamentally, I like that from a story standpoint. I think looking at the second half of this year, I actually think that the pullback in, constriction that we've seen is a healthy one. once you get too far into a rally, I think people start to get a little nervous. I expect a lot more chop, actually, because I think there are some headwinds. You know, we talked about Iran. We have a new Fed chair that the market has to get used to. Even some of the second order effects with petroleum products beyond the price of oil having some supply constraints. So I don't think it's just green from here, Lou, but I am very optimistic because, again, there's multiple ways the market can win. It's cheap right now. We could see the compute demand really make its way through the market narratives coming into this earnings season. You know, I think one thing we might want to talk about next is just what dogs aren't barking, what has not driven growth this year, which has been very different than several years past, is the Mag 7 names are kind of flat.
Are they ready for a comeback? I mean, LL Cool J, let's bring it on. Don't call it a comeback. We've been here for years. Or is it like a legit breakout? Because earnings growth, if I just look at earnings, 63% earnings growth for the Mag 7 collectively last quarter.
Right.
Stock prices actually went the other way, even though they're growing earnings. How does that change?
It is interesting. I was talking about this the other day, actually. You know, they set expectations and then it's almost like expectations will be beat, but then we'll see a sell-off. Right. And so far, I mean, we could recollect real quickly, Q1, 85% of S&P companies beat on earnings, which is, you know, a blowout, you know, expectation. So far, we're looking at about 80% for Q2. But to your point, the Mag 7, we're well below that. The big techs is what I'm looking at here. The hyperscalers, obviously, Google reports this week. Tesla reports this week.
Yeah, what do you expect? Stories. Are you following both of those? Do you own them in client accounts? Or?
Yeah, so definitely client accounts. We own, I mean, they're Mag 7 companies. We definitely own them. And how we've managed the positions, I think, you know, I'm excited about. But what I have my eye on is two things. One, obviously, AI and cloud revenue. Google has all this pent-up demand. This RPO, this committed revenue, basically, how quickly are they able to turn that into, well, revenue and profits? Specifically on their cloud business, I want to see their 60% year over year growth continue at least that rate.
Okay.
And in the segment, and from a revenue standpoint, I want that number to be 22 billion plus. I think those two things are really key for Google to fight the narrative of, well, the AI overspend. Are we actually going to get the ROI on all this?
Correct me if I'm wrong, because I think last quarter we saw that acceleration in the AI spend, not just for Alphabet. It wasn't just the lone standout. You saw it at Microsoft. You saw it at Amazon. So it was broad-based. Do you think we need to see that same trend continue, or can one of them stumble and this market still stays intact in a kind of a bull mode?
You know, I mean, rarely do they all win perfectly all the time. The way I would say this is the market will probably get rocky if one of them blinks.
Yeah.
So maybe they don't all show the...
What's a blink in your mind?
Yeah, so that's what I'm getting at. A blink would be, oh, we're going to pull back CapEx spending. Oh, we somehow see a different storyline all of a sudden. If they go that route, you might see more of a sell-off on the chip names. You might see further contraction in some of the big techs. If that did happen, I think it wouldn't be a very positive thing for the markets. The middle path is more of what I would like to see. The other thing I don't want to see, if I could continue on that train of thought, would be for these big techs just to point at their balance sheet earnings. Google has a stake in SpaceX.
Yeah.
They could point to that and say, oh, there's our earnings. That is not operational earnings. It's not real efficiency, and the market's just not going to buy it.
Yeah. Well, you brought up SpaceX, so I got to go there. I mean, is it a buy yet? I mean, we talked about it last time, what we thought. Now, is there a price level where you say, like, this is a screaming bargain, or interesting to start nibbling on? I mean, how do you view it's about $1.25 right now as we speak?
I think I would start to get excited if it was at that 100 level.
Okay.
When we had the conversation last time, I think it was so easy to poke holes in the SpaceX narrative. What I think was a more interesting story is, okay, if you are going to believe in this stock, what are you believing in? But the truth is the IPO song sang, and here we are. The pullback, you called it very well. Yeah. And so, I think practically speaking, I believe in SpaceX. It's a world-changing type of company. but they're going through the post IPO woes, and we got all this.
So I can't take any credit
too.
because you and I have been in the markets long enough. We see this story play out time and time again, and it's like I even admitted I almost gave in on air because I was sitting next to Marcus Lemonis. He's like, "You have to buy like at least one share." I'm like, "All right, no, I'm not buying a share at $200." Do you see like? Does the IPO market factor into how you're looking for investments? I mean, do you ever invest in early IPOs? Are you looking for pullbacks and for these companies really to mature before you consider them for the portfolios? I mean, I think of names that came in market recent years. Astera Labs has been a great name. Yeah. That's one. There's been a few others that, big tech names, ARM Holdings, a couple years ago, that's turned into a real strong performer. I mean, do you see those as potential buys eventually? Like, how do you view the IPO market?
I think that you have to take them one at a time. Okay. I mean, when we evaluate a company for our book and for our clients, we're always trying to say, okay, certainly individual objectives come into play here. Some people, SpaceX at IPO even, might not have been the best deal ever, but it was according to their investment objectives, it made sense. But like, let's just take what we have in front of us, maybe the Anthropics or the OpenAIs of the world. How do we think about those? World-changing type of companies. I think in the wealth management space, when you're managing money for retirees, you can't take a blind eye to these massive companies anymore. You just can't look at me with the serious, eye and say, okay, a company that's worth $1 trillion or $2 trillion. Some people are saying Anthropic could be worth, I think Gavin Baker said, $3 trillion at IPO. Yeah. Whether that's realistic or not is a different conversation. But when you have that much value in the private markets, it creates waves in the public ones. And I mean, I've been doing this with clients for a little over a decade now. Yeah. I don't think I've ever gotten as much questions about secondary markets at all. And so it has to, I think, at least be a part of your conversation.
What is one of the things, the surprising question you get from clients that you're like, I can't believe this is really bubbling up to the top, but it's a legitimate concern on the part of investors that might not be obvious in the headlines?
So I think there'd be a market's answer to this question and a practical one. At the end of the day, people that are retiring, they have normal questions like, hey, how is all this inflation going to affect me, not just today? Obviously, we can go to the pump, we can go to the grocery store, we see the costs, but how is this going to affect me for the next 5 years? Because I'm really concerned about that. I think that that's a persistent question that I've gotten, honestly, for years now.
So the affordability thing is real with retirees. I mean, it's consistent over time. I mean, that's not, it seems to be the buzzword of the politics right now, but you're saying on the client-facing interactions, it's always at the top of the mind because they see their limited capital, even though it might be substantial. But hey, how does that hold up in an inflationary environment?
I would definitely, I wouldn't even just limit it to retirees. I mean, we could look at the Michigan consumer sentiment and consumer confidence numbers. Yeah. They're low. Why? A lot of the reported, attribution of all that has to do with exactly this, the pressure that consumers are under from an inflation consequence. And so it is very, I think, a political word right now, but it's hard. When you talk about the economy and how it's doing, there's sort of the financial economy on Wall Street and then the real economy on Main Street. And I think that affordability is always going to be a part of that conversation. Yeah.
You brought up consumer sentiment. You look at consumer spending though, and it's actually moving the other direction, right? I mean, as low as we got in consumer sentiment, even worse than the financial crisis, even worse than
it's like low.
Yeah, low, like super low. And then spending really didn't budge. I mean, it's been fairly consistent. How do you view the health of the consumer and how does that inform the investments you're making?
I love that you brought this up. So for all of you could even call it hand wringing about the sentiment and all these things. At the end of the day, you have to watch what they're, consumers, everyday Americans are doing. Yeah. Look at the retail sales numbers. Look at, spending across the board. Americans are a lot more durable and strong than we give them credit for sometimes. And so that makes me proud to be an American. I think I don't see as weak of a consumer, and I don't evaluate the consumer only on a sentiment metric like that. I totally agree.
Yep. If you haven't noticed, we're all about all filling, zero fluff, and so is our email newsletter where we deliver insights, one headline that you should probably ignore, one chart you should absolutely pay attention to, and one investment idea that you should follow to increase your bottom line right alongside ours. So if you're not signed up yet, go to thebigskinny.com, sign up for our newsletter. If you can't be bothered to give up your email address, that's okay. Give us a follow on Twitter or on YouTube so you never miss another episode. Do you think there's any sectors, let's just kind of bop around a little bit here before we run, any sectors that are just screaming bargain or contrarian play? Like, is housing interesting? Do you like biotech? I mean, where do you see new opportunities emerging in this market?
You know, I don't like to be a gambler with this stuff, Lou. You know, I
well said.
Yeah, you know, I think biotech, to me, if you're a really great biotech investor, it feels to me like you're almost still rolling the dice on this stuff. I mean, we've talked about Eli Lilly before, and I'm bullish on Eli and just everything there with the GLP-1 technology and those types of things. But to me, I think that sometimes you find these deals in plain sight. You know, you look at a company like Microsoft trading at 18 to 19 times forward earnings. It's near its decade low still. I mean, it's kind of been a laggard here. People have been calling it the lag 7. So the first half of this year, but you just don't see really amazing companies trading at those kind of multiples typically for very long. And so I'm more prone to say, I like that name with that kind of leadership and, Satya and the just incredible diversity in their business verticals. And, I could go on, but
I agree. I think Microsoft's super compelling here. What do you make of Nvidia trading at it's like the S&P 500 now? It's cheaper than it was, to start the year.
I kind of look at some of these big tech names, and I like the valuations I'm seeing. I think a thesis on Nvidia, you kind of have to believe that they're going to get re-rated because of their size. They've kind of been limited almost because of how big they are. They've been limited because a lot of the hedge funds short them. And then there's like this, how much of a forward earnings multiple should you give a company that's building out the hardware? And I mean, if I could cut to the chase, I really do believe in Nvidia at this price. And, I think over time, the companies like Nvidia, companies like Google, they're going to be the $10 trillion names if we fast forward even 3 or 4 years.
No, I agree. I think, and I'm curious your thoughts on this. We were here before with Apple. If you remember, it traded at like the low end, like 20 to 23 times earnings. And then it got re-rated when services grew fast enough and became a bigger piece of the pie. I mean, I think the setup could be similar with Nvidia. You think the same is possible there? Because like Apple's now trading at like 31 times. It's,
I think it even pushed up further. I think that they were approaching 40 just because of their most recent bump. And there's a really interesting story there with Apple too. But no, the short answer is I think that you're watching Jensen build that out right now. I mean, you're seeing them go and expand the CPU business. You're seeing them even broaching the open source agent world. And so you're going to see them expand that. And I think it's going to be really great for basically the multiple that they can command.
Yeah, no, I agree. I think that one will play out well. A couple last minute questions here. Biggest mistake you've ever made in investing? What'd you learn from it?
So I think I think this is a really good thing. Sometimes when you start investing early and you make some mistakes, it really teaches you to respect the financial markets. And so I got into some
biotech names.
Look, thankfully I've stayed away because I learned the hard way. But actually just buying options early on in my investing career in my own personal accounts. And when you start playing with a real, I would say, too confident, too quick with some technical indicators and some leverage, that's a recipe for disaster.
Some might call it gambling, but
well, exactly.
What's the success look like for you and your clients, and like where can people find you more regularly to work with you?
Oh, thanks for asking. In terms of what success looks like for our clients, we help people replace their paycheck. So, hey, we've worked hard, we've achieved the American dream, we've reached financial independence. We need to take this nest egg and again, replace our paycheck. How do we do that, Ted? We believe in a 5-pillar approach with the investment and retirement strategy. So income strategy on top of an investment strategy. And a really important thing to layer on with that, we call it the core 3, would be a tax strategy with it. In terms of where people can find me, easy to find me online. Ted Thatcher, brightlakewealth.com is an easy place too.
Awesome. And so you have a holistic approach to wealth management.
Absolutely.
You also think Alphabet's going to print 60% growth in cloud and a 20 billion or north number of that. So I think you're right. It's always a pleasure to have you here. We'd love to have you back again soon.
Thanks, Lou.